Hello ladies and gentlemen, this is Sylvia of CPDbox.com. Welcome to this video with my answer to one of your questions. And this one will be related to the area that is relatively untouched by IFRS, or at least not directly addressed. If you have your own question that you want me to respond, then send it to me via our website. And if it's useful for many people, I will answer it in a video like this one. Today's question comes from Edmund from Singapore, and here we go. I am now preparing the financial accounts of a company which is forced to cease its business, and it is apparent that the going concern basis is no longer appropriate. I am not familiar with the presentation of the accounts using the basis other than the going concern. Please, could you provide a little guidance on how to prepare the financial statements under IFRS when going concern assumption does not apply? Well, this is another great question. I think that all my readers ask great questions, by the way. So, what is going concern? Well, it is one of the basic assumptions described in IAS 1. And basically it says that all entities have to prepare the financial statements on a going concern basis unless management either intends to liquidate the entity or cease trading or has no realistic alternative but to do so. So it is the assumption that the company will continue in its operations within some foreseeable future, simply speaking, right? Well, the trouble is that IAS 1 doesn't tell us how to prepare the financial statements when going concern does not apply. There is no description of what you should do, how you should apply IFRS in this case, and what policies to adopt when you're not going concern. Well, it means that we have to apply IFRS standards to the best of our knowledge, and you have to consider carefully your own individual circumstances to arrive at appropriate basis of accounting. So, for example, some jurisdictions use so-called breakup basis of accounting. It is not defined in IFRS, that's true, but it is defined in the legislation of some countries. So if you apply the breakup basis, then the objective of financial statements is not to assess the financial performance of an entity as undergoing concern, but here you need to assess whether the company has sufficient assets to cover its liabilities and whether after the liabilities are settled, there is some surplus or something left to distribute to the shareholders. However, your financial statements, statement of financial position or the balance sheet and the statement of total comprehensive income will still look almost the same way. There is no special format or anything, right? So it is more about the way of looking at individual assets and liabilities, about valuing them and presenting them. So I'd like to outline a few issues to be aware of. First of all, you still need to comply with all the requirements of all other IFRS standards, even if you're not going concern. So not applying going concern does not make an excuse to depart from IFRS. That's simply not true. Another thing, presenting your assets and liabilities as current or non-current. While many people believe that they automatically must present all assets and liabilities as current if they are not going concern, which is not true. So if you classified your assets as non-current under IAS 1, then they are non-current. While they can become current if they meet the criteria in IFRS 5, non-current assets held for sale and discontinued operations. So if you plan to sell your property, plant and equipment and you actively started to offer it at the market, then yes, they are held for sale. They meet the criteria in IFRS 5. And this can be true only about some portion of your property, plant and equipment. So, for example, you stopped production and trading and now you started to offer some big machines for sale. Okay, then classify these machines as current because they meet IFRS 5 criteria. But you didn't do the same thing with other assets like cars, computers. So then you have to keep them as long-term assets. Well, it brings me to another important consideration, which is impairment. Well, liquidation, cessation of trade or production, and after all, not going concern are all indicators of impairment. Why? Well, because you're not going to use your assets to generate future economic benefits anymore, and as a result, the recoverable amount can sharply fall down below their carrying amount. And IAS 36 requires performing the impairment test on tangible assets when there is an indication of impairment. So there you go. Sure, it doesn't necessarily mean that there will be the impairment, because the fair value of your assets can still be higher than the carrying amount, but you are at risk and you have to test it. Another consideration, valuation of your inventories. Well, as you might remember from IAS 2, you have to carry your inventories at lower of cost and net realizable value. When you decide to close the business, then the net realizable value of stock might sharply go down because you are probably going to sell off everything you have in the warehouse. Next point, onerous contracts. It can happen that some contracts can become onerous or loss contracts as a result of your decision to cease trading or close the business. Just for example, you might need to pay high penalties for early termination of your lease contracts. So therefore, you maybe need to make a provision. Next, government grants. They can become repayable if you're not going concern. And finally, you have to show very clearly that the financial statements are not prepared under going concern assumption. That's it for today. The information in this video is not a substitute from a professional judgment of CPA of your own situation and circumstances, and you should consult CPA or other qualified professional. Thank you very much for watching. Please sign up for my channel. If you liked it, you can sign up for our free newsletter on our website with lots of articles, videos. We offer courses and other resources, so share this video with your friends and colleagues and stay tuned. Bye.